Welcome to StokTok's deep dive into Visa Incorporated. Visa is the world's largest payment processor, a financial infrastructure company that connects consumers, merchants, and financial institutions through credit and debit card networks. At the time of recording, Visa is trading at $331.27. Over the past 52 weeks, the stock has ranged from a high of $375.51 down to a low of $293.89. The stock has moved up 7.89% recently. Price is currently trading above its 50-day moving average of $310.49, while sitting just below its 200-day average of $331.98. The Relative Strength Index, a momentum oscillator measuring overbought and oversold conditions, is at 67.7, suggesting neutral momentum. Let's work through the fundamentals, scene by scene, starting with a quick business overview. Visa operates the world's largest digital payment network, generating revenue primarily through service fees, data processing fees, and transaction fees on credit and debit card volumes across the globe. The company's core moat rests on the scale of its network. The more consumers and merchants using Visa cards, the more valuable the network becomes to banks and financial institutions that must participate. This creates a virtuous cycle of network effects and switching costs that competitors find extremely difficult to replicate. Our StokTok score for Visa stands at 60 out of 100, rated as a hold. Breaking this down across 5 dimensions, valuation earns a 3 out of 20 stretched relative to fundamentals. Financial health scores a 15 out of 20 solid but not exceptional. Profitability is rated 20 out of 20, among the best we see. Growth gets a 14 out of 20, moderating expansion. Smart money signals 8 out of 20, mixed institutional conviction. Now valuation. The question every investor has to answer is, are you paying the right price? Visa is trading at a price-to-earnings ratio, or PE, of 29.17 times trailing 12-month earnings. The forward PE ratio, using analyst consensus estimates for the next 12 months, sits at 26.04 times. For context, the technology and financial services sectors have historically traded around 18 to 25 times earnings, so Visa is trading at a modest premium. The price-to-earnings growth ratio, or PEG, which divides the PE ratio by expected earnings growth, comes in at 1.66, meaning the market is paying roughly $1.66 for every dollar of expected annual earnings growth, generally considered fair value when near 1.0. However, the EV to EBITDA multiple, which measures enterprise value relative to earnings before interest, taxes, depreciation, and amortization, stands at 23.07 times, which is elevated relative to peers. The price-to-sales ratio is 17.64 times, indicating the market is willing to pay $17.64 in market capitalization for every dollar of annual revenue, a very high valuation multiple. Our DCF model at the time of recording suggests the stock is trading at a negative 17.87% margin of safety, meaning we view it as 17.87% overvalued relative to our estimate of intrinsic value. Turning to the latest earnings results from Q2 2025, Visa delivered an earnings per share of $2.98, beating the consensus estimate of $2.85. On the revenue side, the company reported $11.23 billion in total revenue. However, we note this significantly missed analyst expectations. Revenue growth year-over-year expanded at 3%. Operating income reached $7.56 billion, while net income came to $6.02 billion. The market reaction reflected mixed sentiment given the revenue miss despite the earnings beat. Wall Street analysts at the time of recording maintain a consensus mean price target of $396, with a high target of $450 and a low of $323, based on 35 total analyst estimates. That implies roughly 19% upside from current prices if the bull case plays out. Market sentiment around Visa, as of the creation of this video, leans bearish, with investors expressing concerns around Federal Reserve interest rate policy, geopolitical tensions, crude oil price pressures, and broader economic uncertainty. In our view, the valuation is stretched. The stock is priced for near-perfect execution and sustained high growth at a time when revenue expansion has decelerated materially. Moving to financial strength, how solid is the foundation? Visa's Piotroski F-score, a 9-point health checklist that examines profitability, leverage, liquidity, and operational efficiency, stands at 7.0 out of 9. This is a strong score, indicating the company demonstrates solid financial discipline and low bankruptcy risk. The Altman Z score, which combines 5 financial metrics to estimate the probability of corporate distress, registers at 7.72. Scores above 6.99 typically indicate a safe zone with very low insolvency risk. Visa comfortably exceeds this threshold. On the leverage front, Visa maintains a cash-to-debt ratio of 0.77, meaning the company holds 77 cents in cash for every dollar of debt outstanding. While not a fortress balance sheet with more cash than debt, this is respectable for a company of Visa's scale and stability. Interest coverage, the ratio of operating income to interest expense, stands at 46.13 times. This is exceptionally strong, meaning Visa can cover its annual interest payments 46 times over with its operating cash flow. The current ratio, which measures short-term liquidity by dividing current assets by current liabilities, is 1.11. This suggests the company has $1.11 in liquid assets for every dollar of near-term obligations, adequate but not abundant. Debt-to-equity ratio sits at 0.55, indicating moderate leverage. For every dollar of shareholder equity, Visa carries 55 cents of debt, which is conservative by modern corporate standards. Overall verdict: Visa's balance sheet is rock solid. The company has the financial flexibility to invest in growth, return capital to shareholders, and weather economic downturns without stress. Next up, profitability. Is this business actually making money efficiently? Return on invested capital, or return on invested capital, the pre-tax profit the company generates on every dollar deployed into the business, stands at 29.10%. This is exceptional and well above the 9 to 10% average cost of capital, meaning Visa creates substantial shareholder value with its capital deployment. Gross margin, which measures the percentage of revenue remaining after direct costs of delivering services, reaches 81.08%. This is extraordinarily high and reflects the capital-light nature of payment processing. Visa is not manufacturing physical goods. It is operating a network. Operating margin, measuring profit as a percentage of revenue after operating expenses, comes in at 66.98%. This means nearly 67 cents of every revenue dollar converts to operating profit before taxes and interest. Net profit margin, the bottom line measure of profitability, registers at 50.23%, meaning Visa retains just over 50 cents of every revenue dollar as profit attributable to shareholders. Free cash flow margin, measuring cash available to shareholders and debt holders as a percentage of revenue, reaches 49.24%. This exceptional figure indicates Visa converts nearly half of all revenue into cash that can be distributed or reinvested. In the Q2 2025 earnings, these margin profiles remained consistent with historical performance, demonstrating the sticky, durable nature of Visa's business model. The company's ability to maintain margins at scale, generating billions in operating income on billions in revenue, sets it apart from nearly every other business. This is a profitability engine. Onto growth. Is this business expanding, and at what rate? Over the trailing 3 years, Visa has grown revenue at a compound annual rate of 10.90%. Stepping back to the 5-year view, the company has achieved revenue growth at a 5-year compound annual rate of 17.30%. This represents meaningful deceleration. The company was expanding at a faster clip 5 years ago than it is expanding today. The most recent quarter, Q2 2025, showed revenue growth of just 3% year-over-year, signaling further moderation in the growth trajectory. Book value, the accounting measure of shareholder equity per share, has grown at only 6.40% over the trailing 3 years, lagging revenue growth and suggesting the company is deploying excess capital back to shareholders via share buybacks and dividends, rather than reinvesting to drive internal expansion. Dividend yield, the annual cash dividend paid as a percentage of share price, stands at 0.75%. This is modest by dividend stock standards, but reflects Visa's capital allocation priority. Returning cash to shareholders through share repurchases is the dominant mechanism. Looking ahead, the consensus estimate for earnings per share in the next reported quarter is $3.21, with estimates ranging from a low of $3.14 to a high of $3.27. This will be an important catalyst to watch as the market assesses whether management can re-accelerate revenue growth or if deceleration persists. In our view, the growth picture is moderating. The high growth runway that once characterized Visa is narrowing as the company matures. Now let's talk smart money. What institutional capital is actually doing with this name? 38 top-tier institutional money managers, what we call gurus, currently hold Visa in their public equity portfolios. Among institutional investors filing 13F forms, which disclose holdings quarterly, only 23.9% were net buyers in the most recent period, meaning the majority of institutional capital is either holding flat or reducing exposure. This is a bearish signal when the threshold of sustained institutional buying momentum is considered to be 50% or higher. Insider ownership, the percentage of shares owned by company executives and directors, stands at just 0.10%, extremely low, suggesting management has minimal personal financial stake in the company relative to their compensation. Over the past 3 months, there have been 0 insider purchases and 1 insider sale, indicating that those in the know are not rushing to accumulate shares at current prices. Examining the largest Guru holders using Dataroma data, Chris Hone at TCI Fund Management holds the largest stake at 18.12% of his portfolio, though he reduced the position by 1.19%. John Armitage at Edgerton Capital, with a 12.47% position, is one of the few adding aggressively, increasing by 37.24%. Chuck Acker at Acker Capital Management, holding 10.29% of his portfolio, reduced his stake by 9.99%. Value Act Capital holds 8.58% and added 9.73%. AKO Capital holds 7.68% and reduced by 9.27%. The message from smart money is mixed. Some of the world's best investors are trimming exposure, while others are building. This divergence suggests institutional conviction on Visa remains uncertain at current valuations. And finally, the verdict. Let's bring it all together. On valuation, Visa is stretched, trading at a 17.87% premium to our view of intrinsic value with a PE of nearly 30 times, elevated relative to both the sector and historical averages. Financial strength is solid. The company has a pristine balance sheet with fortress-level credit metrics and no solvency concerns whatsoever. Profitability is exceptional. This is one of the most profitable, capital-efficient businesses on Earth with net margins above 50% and return on invested capital near 30%. Growth is the constraint. Revenue expansion has decelerated from 17% 5-year trends to just 3% in the most recent quarter, and the company is prioritizing buybacks over reinvestment. Smart money is divided. Top-tier institutional investors are mixed in their actions, with some trimming while others add, suggesting uncertainty at current prices. The latest earnings in Q2 2025 showed an earnings beat but a revenue miss, signaling the company is managing profitability through cost discipline rather than organic expansion. Our overall thesis is this: Visa is a world-class compounder with durable competitive advantages, exceptional unit economics, and a fortress balance sheet. However, at the time of recording, the stock is priced for perfection. The market is assigning a premium valuation to a company whose growth rate has contracted sharply. We view the risk-reward as unfavorable at current levels. The setup looks interesting to us only if the stock corrects toward a more historically typical multiple, or if management credibly re-accelerates revenue growth. Everything in this video is our interpretation of publicly available data and not financial advice. Please consult a licensed financial advisor before making any investment decisions. That's the deep dive on Visa Incorporated. Like and subscribe so we can keep providing you with no-nonsense, data-driven analysis of stocks. We will keep updating our videos as soon as new data that affects the stock becomes available.